Welcome, everybody. I'm Nicolas Veron at Bruegel, and it's my pleasure to introduce this session about the insurance sector and how it can contribute to what we now all know as the Savings and Investments Union. I still see we at Bruegel are sometimes in catch-up mode because I think the European Commission now calls it the Savings and Investments Union, plural, but we'll adapt gradually to the fast-changing semantics of Brussels. Anyway, we're very grateful today to have three stellar speakers to talk about this in the order in which I will ask them to make introductory remarks. Andrea Cironi, chairman of the board of Generali, and of course a contributor to many economic debates. I have to mention, to state the obvious, that Generali is also a cherished and generous donor of Bruegel. Jörg Asmussen is the Chief Executive Officer of the German Insurance Association. Some of you in this room who have long memory remember Jörg as a policymaker in a number of different policy areas, but he's now an insurance person, and we are grateful to him for coming from Berlin for this. And Petra Hilkema, of course, is the chair of the EIOPA, the European Insurance and Occupational Pensions Authority, which is based in Frankfurt but serves the EU and is in charge of supervisory convergence and regulatory harmonization, I guess is the right language in the area that the name indicates. I should also mention, even though he's not on the program, my colleague at Bruegel, David Pincus. David is here. He joined Bruegel in May 2023. He works at the intersection between social welfare policies and more generally what you could call the real economy and the financial sector. So he's very much plugged into all the questions we will debate today, and he's been very instrumental in preparing this session. With that, I will start with brief introductory remarks from our three speakers, and over to you, Andrea.
Thank you very much. Does it work?
Yes.
Yeah, okay. Thank you very much for this invitation. It's a pleasure to be back at Bruegel. So just a few words, introductory words on my side. I think that when we talk about the Saving and Investment Union, I think that the rationale, which we all read in both the Draghi and Letta report, is rather simple. We have a competitiveness issue at Europe, which is linked to a, let's say, productivity gap, which is rising. This has a number of underlying factors, which could be, let's say, related to the mobility of talented workers. It could be related to, let's say, a number of factors, but one of those factors is clearly the lack of integrated capital markets, okay? Now, I think that there are a number of reasons behind this, and these are in some way also simplified in the fact that we have 27 exchanges, that we have a number of CSDs, a number of CCPs, and it is clearly highlighted in both reports. As far as the role that the insurance industry can play, I think it's quite clear. First of all, in terms of size, we are probably the largest institutional investors in the union, with some, almost 10 trillion investments, about 70% of which are invested in Europe, in the EU. And I think even more important than that, we are long-term investment. So we are investors that, of course, this is related to the fact that we are matching our liability structure. And as I mentioned, 70% of that goes into EU corporate sovereign bonds and equity. So this is the general framework. Now, if we go more specifically on some of the issues that are underlying the Saving and Investment Union, the view is very simply that first, on supervision, we believe, as you know, Generali is a large insurance group that is active in quite many EU countries, And we see the fragmentation of, I wouldn't say regulation, because regulation is very much EU defined, but in supervisory practices as a very significant problem, because it means that at the end of the day we have to deal with different supervisory practices in different countries. Therefore, we believe that more integrated supervision and a stronger role for EIOPA, eventually in terms also of granting the fact that all national supervisors do not apply, let's say, what is called gold plating, we see that as extremely important. Okay. To be frank, when we talk about the Saving and Investment Union, I mean, I had the past as chair of the Italian Stock Exchange, and to me, one of the main reasons why we do not enjoy from a single wide, large liquidity pool is again because we have 27 different exchanges and 27 different regulators and supervisors. So to be frank, I think in that respect, we should aim for a single supervisor and therefore more power to ESMA. That's the way I see it. On the other specific topics that are going to be addressed soon here in Brussels, I think that on pensions, we very much appreciate the work that EIOPA has been doing, also in terms of dashboards, but we very much see that as an issue related to the demographics. And my country is quite an example. As I always say, I was born in '64, and in Italy we were more than 1 million. Last year there were 370,000. So there is quite an issue to be dealt with also from a pension point of view. Finally, as far as securitization is concerned, which is another topic that is going to be addressed, we see it favorably, but to be frank, once again, in terms of investment from the insurance industry, we see it a bit problematic because of the capital absorption under Solvency II and the burden from a due diligence point of view that is associated to this kind of investment. So we don't really see, while we see it favorably to create more liquidity and funds available for SMEs and companies generally, we would not see ourselves as major investors in this kind of tool. Final point on the other issue which is going to be dealt with is low-cost investment products. As we said already more than once, for us the key point is not low cost, but it's, let's say, value for money. And we believe that if the focus is only on low cost, there is a risk that it ends up with, simply ETFs which are offered by US intermediaries, so it's probably not the ideal situation. And I stop here because I know that we're very much time constrained. Thank you.
Exactly. We want to have a conversational moment, but this is very useful scene setting. You've mentioned supervisory integration, of course, both in terms of insurance and in terms of capital markets. The theme of capital market supervisory integration is very high on our agenda at Bruegel this year, and it's very, I think, timely and useful to discuss the interplay between this kind of ESMA-centric discussion and the parallel discussion about EIOPA. Well, I'm sure we'll come to this with Petra, but first, Jörg, over to you.
Yeah, thank you very much. Thank you very much for the invitation. I'm really pleased to be on a distinguished panel like this. How can the insurance sector contribute to the Savings and Investment Union? My sense is always that our contribution, and I will lay this out in details a bit later, is often underestimated. Because if you look at the Draghi report, everybody knows we were colleagues, we are still friends, but he mentions banks 61 times in his report. In insurance companies, only 3 times. I already complained about that. Yeah. So that is not what our role is in this kind of integrated financial market of the EU 27. So I think we can contribute in a number of areas. The first one is, of course, the most well-known one of investing. Second one is that we really carry risk, that's risk protection. And third is also about jobs. Because we all need this, because Europe is the host of some of the largest globally active insurance companies and reinsurance companies that we have. And in order that they stay competitive, that's important that they face the right regulatory framework, for example. But the first point is, Andrea already alluded to that, we are the largest investor. Companies that are active in Germany, we invest 1.9 trillion euros altogether. And the figure is the same, 70% are invested in the euro area. So the investment side, I think, is nearly in dispute, because Mario Draghi said we need roughly 750, 800 billion euros in additional investment. And it's well known that on average, 9 out of 10 euros are private money that are invested. So where should the money come from? Yes. The second issue is that we carry risk. Yeah, risk is always there when you do business activities, and we need to protect this. Natural disasters are an increasing issue with the ongoing climate change. We have cyber as an additional systemic risk, but it also has, we have risk on the individual side. How long do you live? How healthy you are? So that's the second large economic function that the insurance sector can fulfill. We carry risk. And third one, that is often not mentioned, but we provide very good, safe and well-paid jobs. In Germany, nearly 500,000 people, 500,000, work in the insurance sector. But there is one precondition that we all can fulfill these three different functions. That is, we need to be able to sell our products. What we need is a strong transmission link between products and investments. Because we cannot invest if you're not able to sell the products, which means we collect savings from retail investors, bundle it, and then we can invest into the digital transformation, the green transformation. So that is a transmission link that we always have to stress, because it's often forgotten. And there were some attempts in the past to make it more cumbersome to bring these products to retail consumers. So this is, I think the Savings Investment Union only can be successful if we create a strong link between products and investments. And I think there is no silver bullet when it comes to products. Yeah, there's often the focus on any kind of individual products. What we need is a variety of products that we have in the EU common market, because retail consumers are simply different. Do they want guarantees? Don't they want guarantees? What level of guarantees do they want? But what we need is really a link between the product, savings, which are often for retirement, and then the investment side. Thank you.
Thank you so much. This was very thought-provoking. Petra.
So thanks for being here. I see a lot of familiar faces, and it's great to be on a nice panel. Savings and Investment Union, from a supervisory perspective, maybe 3 points I want to make. And the first one goes back to the Draghi report, and recognizing that if you read the Draghi report, the first 2/3 of that report is not about us. It's not about how we're going to make insurance more competitive. It's about how are we going to make Europe more competitive? How are we going to be more tech savvy? How are we going to develop a tech industry? How are we going to not completely lose out in a tech race where we are already late? That is the first question. And then in the end, there is the question, how are we going to finance that? that is the role that Draghi sees for our industry. And I think it's always good to keep in mind that we have a supporting actor role, and we're not the main characters maybe in the thinking of Draghi. And if you then look at how that can be done, of course, we're not mentioned, Jörg, but there's a lot of thinking about how indeed the investments of insurers, and I agree with the numbers that Andrea said, almost 10 trillion, 70% already in EU. How can that be even better invested? But it's also, in addition to that, thinking about how can we have at least part of the savings that is now happening in bank accounts move into savings products. And this is where EIOPA has a keen interest as well to support that where we can, because it would mean that we would be also working on closing the pension gap. And we have a serious pension gap. And this is where we link into to the Savings and Investment Union, which can benefit both facilitating investments in the transition, but also helping people to save for their retirement. The big question there is, of course, how do you tell people who have money in their bank account with a bank guarantee up to 100k with a European supervisor to move it to an insurance product where still 40% believes it doesn't have a good return. We just published our report where there is no insurance guarantee scheme, and we've seen, again, we've seen failures. Failures happen, but failures will and maybe should even happen more if we really want fintech. And that's a scary thing. I have a supervisor said that. But if we really want to see fintechs in our market, we cannot combine that with 100% non-failure as a supervisor. It goes back to how much rules, how much certainty do you want. But if you say we want less rules and less certainty, it might mean that you need to start focusing on exit plans. Not meaning Google buying you out, but actually it didn't succeed. And that can happen if you really want innovative new companies to start in Europe, including in the insurance industry. So another focus of us will be on recovery and resolution, but mostly when you license particularly these kind of companies, the newer ones, the fintech ones, do they have an exit plan? And I think if they have an exit plan, we can think. So we need to think about how we accommodate a market that wants maybe have more fintech, that wants to give the same sense of security. And I can say that in this room. Outside I have to be careful because I'm not saying that currently insurance is not secure. And I think it's a lot more secure than what the 40% number says in our Eurobarometer. I do think that there are products out there that are not good. So that's one. Second is on the cost, the burden reduction that needs to happen. We're working on that, and I'm not married to a percentage, I always say, but I'm more than happy to very pragmatically look, do we really need everything, and can we achieve the same goal in a different way? I'm on that. And if that is less or more, then that is what it is, and we will indicate the risks of doing more. And then EU institutions can make a pick, and as supervisors we will advise. But here what I want to say is that it's very important as supervisors, in a time that, I wouldn't call it panic, but I mean, every news item at the moment starts with Trump is doing this, we need to respond, EU doesn't know what to do. I think what we need to do as supervisors is really provide stability in how we respond. So we need to continue to look at the risks, we need to identify those risks, and we need to accept that there's all kinds of things happening in the political arena, but the risks are not gone. And my final point is a question more. What if we realize a 25% or maybe 35% burden reduction? How would that all of a sudden make the EU economy a lot more competitive? And how would our industry even be a lot more tech savvy? I mean, I don't think that that answer is yet there. I haven't heard talks about that. And moreover, final question, with whom are we going to compete? Are we going to compete with each other? Because that is what I very much see. Or are we actually, as a world, going to compete as EU with the world? And I think that, in the end, the answer to that question will decide the success of the Savings and Investment Union.
Thanks so much. Thanks also for your wonderful time discipline. There is, as many of the audience, including online, are aware, we use Slido for asking questions. So you can ask questions on Slido using the hashtag insurance. Hashtag insurance on Slido. Please feel free to ask questions. Actually, to open the Q&A, I will ask my colleague David Pincus to start us over.
Thank you. Thanks a lot for this very interesting discussion. I think you touched on a lot of important points, including that the most obvious role for the insurance sector and savings and investment union is this question about how to finance the real economy, how to close the investment gap, and all of these questions. Pensions get more attention than insurance in this discussion, but the characteristics of the insurance sector that you mentioned, Andrea, that you're long-term investors, that you are very large investors. I mean, this is something that the insurance and the pension industry share. You, Jörg, mentioned the products, that we need a stronger link between products and investment in order to foster investment. My question here would be, why are these products not there, and what kind of products do you envision for the insurance sector to contribute more to closing the investment gap? Thank you. Yes. Why are the products not there? Did you say that we need a stronger link between the products and the investment?
Maybe I was imprecise. I mean, the products are there. For example, you have EBIPs, yeah, investment-based insurance products, which are there. What I was arguing, that we always have the macro side. You invest here and you are asked, can you do more for venture capital, and can you do more in renewables, so whatever. This only works if you manage to collect the savings from retail investors. And if you follow the debate, you often have the idea that people focus, there is one European savings product. And I think that is not the way forward. We have a variety that exists in Europe. And you have insurance products, you have other products. I would also, for the future, for the savings and investment unions, look that we have a framework that allows for a variety of products. Some are savings products, others are more linked to retirement, which I think is often key given our demographic situation. So the products are there. What I'm arguing against, that we narrow it down, that we think there is one silver bullet that can now, in the savings and investment union, finish the deadlock in which we are in, that we don't have enough money to finance certain aspects of the real economy. There are other products which are already there but are not flying. I mean, the label PEP is well known in this circle.
Sorry, what is that?
That's the Pan-European Private Pension Product, PEP. Yeah, nobody knows it. It's there. We have a legal framework for this, but according to my knowledge, there is maximum one company that supplies this product in the common market. So it's,
is that a German company?
No. But why is this the case? The idea is not a bad one, but we had the product has so many positive characteristics combined with a very harsh cost level that there's nearly an empty set if you want to provide this product. So it's simply over complex. So we have a PEP review. This is one way maybe forward. Others that you build on existing national products that you then label in a right way, because especially in life insurance, you often have a certain link to existing domestic tax systems and social security systems. So a label could also be a way forward. So first, there are existing products and there are avenues for the future.
Andrea and Pietra, any views on David's question? Petra.
Yeah, so I have a view on first of all, it's about pensions, but pensions, I think, is used by savings for later. And that can be supported by either a Pillar 2 or a Pillar 3 product. And that's why we promote dashboards. We feel that just state pensions won't do it. They're going down also in how much they will make up of retirement income to a low 30%. So you will need a second and a third pillar. And we feel that dashboards will actually help policymakers to assess where they should spend public money, more into Pillar 1 or supporting a Pillar 2 or a Pillar 3 product. And I think it's more likely to support a Pillar 3 product. So that's one. Second, the PEP was not a success at all, and we published a paper on why we feel that is. And actually, I think there's a lot of things that we already touched on here, why things sometimes doesn't work. There was a big focus on the cross-sector, on the cross-border part, which made it highly complex, so complexity. That was one. There was a cost cap that entered very late into the negotiations, which I would still say if you really scale at an EU level with a simple product, you might be able to do it for that cost, but definitely not in a startup. So the costs were too high. And then there was protective measures by national markets. There was no equal tax treatment, and there was a big consciousness that it could cannibalize on the existing products in the market. And that is exactly why these things don't work. And it goes back to, first of all, with whom are we going to compete? How do you do the costs? I would say fair value for money. If a product is value for money, that means that the price reflects the cost, the services, and the returns provided. Those three things will end up in a price. And if that is fair, you have a fair price. And you should have that from the start till the end of the value chain. That's what we see. But if you deliver on that, you don't need a cost cap. It's just as simple as that. So that is also something. The cross-border element and the complexity relates directly back to the fact that we have minimum harmonized laws, we have social and labor laws, etc. So Europe is very diverse. If you want to overcome that, you could think about a label. And then let's say why this is needed. If I talk to younger people, including my kids, they're going to be rich. Mom, I'm going to be rich. Great. How are you going to be rich? I'm going to invest, Mom, and then I'm going to spend. Okay, cool. It's good, actually, yeah? I mean, my generation wasn't talking about investment, so we got them somewhere, yeah? But then comes the question, what are you going to invest in, sweetie? ETF, Bitcoin, crypto, and stocks, Mom. And then I need to say, well, there's also these pension products that you can buy if you go to an advisor, and they will come with a good guarantee that will give you a lot of security in the long run. They've left the room by that time. So even if PEP is not the thing that we like, and maybe given the track record of PEP, we do need a new name, but at least something, a label, a one-syllable thing that we can add to that list and say, or an X. And actually, wherever, in whichever country you buy it, it has these features, and it's a good thing to save for later. And if you're very young, you can mix it with the other risky stuff. I mean, definitely when you're young, you need to take some risk as well. But you also need something safe out there. And that can actually be a simple product that works for all. And here, Jörg, I'm slightly disagreeing that we need a huge variety of products for EU citizens. I think you need, for many, just one simple product. Look at the default option in Sweden that fits then into the national reality, which is labor and social, etc. But it doesn't have to be a huge variety. It has to be one label that gives a certain outcome that can be trusted, but that fits in a national market.
So I'm not sure it will be labeled X because that has been registered by Elon Musk already, but maybe Y or Z. So Andrea, on this issue of product regulation, where would you stand?
No, I mean, I think they said it all. I agree with Jörg that we do have products available. That was not my point. I think that, as I mentioned, the key point here is value for money. And I think that in the life insurance segment with the different variety that also Petra mentioned, we do have the products available. Of course, if it becomes a priority for Saving and Investment Union, there could be more incentives on the fiscal side, but I think that is not really the issue. The issue I was mentioning is the one on how can we be sure that these 300 billion of euros of savings that are actually invested outside of Europe can be, returned to real economy in Europe? That's the main issue to me.
So Petra, I will put you on the spot again because Andrea brought in, of course, the issue of supervision. And I mentioned this is on our agenda in terms of capital market supervision. But what about insurance? I don't know if we should call it or not the insurance union. I know there have been some semantic discussions about that. And obviously you are the head of an organization which is governed by a board of supervisors, which is composed of the heads of the national competent authorities. So we're fully aware of that. But maybe one way to ask the question is to pick up on something Andrea said at the beginning of this session, which is it's no longer about harmonizing the regulation because that has gone far enough. It's about the supervisory integration to make sure that this harmonized regulatory framework is implemented in a compatible way in different jurisdictions. So how far are we there? Of course, you will tell us that the EIOPA is doing a good job about supervisory convergence, but can you give us more color on this? And also, frankly, is there something to challenge in what Andrea told us? Is there more to be done in terms of regulatory harmonization? How do you see the landscape of policy challenges in that area?
Yeah, so keeping it pragmatic, I fully agree that you need to look at what is not already there or not running well and needs set. I think a lot is going well in our sector. It's robust, and it is actually robust, and we have little incidents, and I think that is very positive. So that is a first. And there is still, and I think when a supervisor talks about bad products being sold, that is not the majority. There's a lot of good things being sold that help protection of and thereby our economy. So that is a first. Second, insurers get one license in a member state and then they sell. And they can sell in all the 27. That's called the passport, and most of you in the room know. But they are confronted then with 27 supervisors. And here, the regulation is not maximum harmonized. Only the prudential regulations, so the robustness is maximum harmonization, but all the other rules are minimum harmonizations, and that actually allows for member states to also have a bit of an own taste in how they then want to organize that, and that's a political decision, but that is a reality. And so and I can imagine if you sit in the headquarters of an insurance group that operates that way, you are confronted with 27 slightly different requests. And I can see that also, and I could do very good the national Dutch perspective because I came from the Dutch Central Bank, and by now I know many countries. I can do the national perspective, but really, if you sit with only a European hat, there's a logic into organizing more European. It's more efficient. And I can say, for example, if you would only have to report your data once, and then we get organized, I think that's sufficient. That's a really difficult discussion. So I think that is a first. Second, what is gold plating? Because if you have minimum harmonization and you add at the national level, that's not per se gold plating, and it might be different. How do you realize convergence? By talking to each other, by issuing opinions as EIOPA. Yet, if a supervisor at my table then says, I abstain from the vote, because I disagree, then how do you make sure they implement the opinion, or maybe they don't? So there is not yet full harmonization. There is even not always good implementation of law that is harmonized. And now I'm talking about enforcing.
So here you're talking about the prudential piece, I guess.
I'm talking about the prudential piece. Why? Because what we see is that EIOPA has powers. We have several powers, and sometimes now you should make more use of the powers. Now that one I maybe saw coming, but also I am trained as a supervisor. So from the day I entered EIOPA, when we saw things, I said, start using our powers and keep a track record whether or not it works. By now we have a few cases where I can just say that we have exhausted all the powers we have, but policyholders are still at detriment. And why is that? Because I can only really stop things, of course, if my entire board agrees on an action. It's a joint decision, which is fine because the things we see are so as such that my board will decide and agree. But the implementation is always with the NCA and their national law and their administrative law. And that does not always work the same. So that is one area where I think we really need to talk. It's the outliers, but it's like with apples. If you don't take out the rotten apple, the whole basket can go to waste. So that is one. Second is the robustness itself of an industry. So we're talking about Solvency II, and I know sometimes it's a burden. At the same time, if it's sunny, an umbrella is a burden. But if it starts pouring, you're happy you have it. So be careful in an uncertain world. Finally, internal models. 60% of our market is currently on an internal model. It always makes me smile a little bit that we talk a lot about how are we going to change Solvency II for securitization, because I wonder who realizes that they're only changing a standard formula and not an internal model. 60% of our larger players are on an internal model. I do think that every of those players think they have a good relationship with their NCA, and so they like that relationship. There's a lot of knowledge in there as well. At the same time, IOPA sits in all the colleges of all the groups. We see it, we can compare. I don't think that there is a level playing field currently also in the internal model space. We are the only ones that can see that. If you want more market there, you could do that too. To sum it up, I think a lot works, and I think a lot works in a beautiful way because we have a lot of smaller players and players that are used to a certain market, and also intermediaries that know that market. Frankly, I don't have a problem with that. If something really works, don't fix it. Work on value for money. But if you look at the wider scheme of things, we need to solve the fact that some bad apples are somehow managing to still stay in the basket. We need powers there. And I also think that when it comes to real level playing field, really rethinking what powers you want at an EU level would be a good idea.
I would like to ask about identification of the bad apples, but I will refrain from that. Yes, Andrea, but I will also have the question for Jörg.
Yeah. No, I just want to add, I fully agree with Petra that the fact that individual national supervisor could act differently is consistent with minimum harmonization. But at the same time, as you mentioned, is first, inefficient, second, is ineffective, and third, it damages the idea of the level playing field, as you mentioned, right? And again, one could say, as you mentioned at the beginning, it's a robust and sound industry. We are, if you take it into account the major players, we're all above 200% of the solvency requirement, right? But there is an issue, which is the capital markets. If we are treated differently, of course, there could be different cost of funding, ratings, and so on. And there are situations where a player like Generali, for example, which of course has an internal model, could go to another European country and say, no, we don't recognize your internal model, which in a logic of level playing field is not acceptable. That's what I was talking about.
Jörg, you are the representative in a way of the national point of view in a generic way, and specifically of Germany. How do you look at those debates, both about regulatory harmonization, potentially beyond the prudential piece that we have with Solvency II, and of course supervisory integration? You represent a diversity of different sizes and types of insurers. So how do you think about that?
First, I would look at the market structure, and I can say for German primary insurance company, only a little bit more than 10% of their premiums are cross-border. So that's the situation of the primary insurance. Exactly, it's 13% of the premiums are done cross-border. I try to lean a bit back because I think it's a fascinating debate, but it's also a bit of an academic debate. and I know that at a think tank I don't make friends if I phrase it like this.
We're not academics, so, you know.
I mean, when we go back, when and why was European banking supervision for the largest, at that time 125 EU banking groups was established? That was after the global financial crisis, because something really was broken. And I think this is currently for insurance not the case. At that time, we had significant dangers for cross-border financial stability. We had Dexia, we had Fortis, we had HVB with its ugly Irish branch. So we really had cross-border issues in financial stability. We had a real supervisory mess because the home host issue was not solved. You couldn't know what was sitting on the balance sheet of a branch that you had. So we had cross-border financial stability endangered with no real working supervisory activity. That was the situation that needed to be fixed. And that was done in a good way, not in a perfect way. Let's say good is, yes, you have the SSM at the ECB, but you still have these NCAs.
National Competent Authorities.
Yeah, which de facto often is a double supervision that you face. Yeah. Because the NCA, so that means the national supervisor, they are not gone. And in the case of Germany, you have even two for banks. So that means you have 3 players here that is additional coordination.
Just to clarify, you mean BaFin and Bundesbank?
Yes, plus the ECB. For banks, that's the case. So there was a step forward. Was it done in a perfect way? No. Could it be done differently at that time? Not. But one has to keep this in mind. So in insurance today, you have, for the larger groups, yes, you have more cross-border activity. For the vast majority, they are very purely domestic. Yeah. Do we have a danger to financial stability? No. I don't see this. I mean, even theoretically, it's difficult to imagine. I mean, we all know the term bank run, and do we have digital bank runs? The word insurance run nearly doesn't exist. Yeah. So I would question if we have the situation as we have it in 2008 and 2009. I can agree we need more convergence. I can agree that something needs to be done if one NCA doesn't apply the jointly agreed rules. That's undisputed. There are more powers in the Solvency II review. I think that should be applied, that's correct. But I don't see the dramatic situation that we have in 2008 and 2009 in the European banking market.
Absolutely.
I think what Jörg says is a lot is true. And if you look at how the ECB was created with 900 people in Frankfurt, that did not result in less people at the national authority. Now, I've come from the Dutch Central Bank. I did fit and proper assessment. You do work as a team. So it's not like one day you have, hey, I'm the ECB, and the next day, hey, I'm BaFin. It works as a team, but still, it doesn't decreases really the number of people, and sometimes you really need to negotiate between Frankfurt and the national capital to get there. So we really have to have good reasons to build another giant if it is not necessary. I fully agree. So that is also why I try to pinpoint on issues we need to solve without a big bang. The driver, I would say, is not only financial stability and an insurance crisis, because I think it's also about trust. And if you see how now those who should not have our trust are misusing the model of passporting and getting a license somewhere where they can get away, at least at the start, with things, and then always sell cross the border. They always sell across the board. They try to get market share quickly. And then when things start to happen, it pops up first in conduct And then if it pops up and we have powers to start to look into it, you can solve it if there is capital. If there's no capital, you end up with a prudential power problem and then powers. That's normally the route. But then you need to be able to solve it, and that is where you sometimes need additional powers. I'm not sure if that will be fully brought only by the review of Solvency II. I don't know. But some are in the news. They're cross-border cases. And my point is that we're now 7 years into Solvency II, and I think we thought we could stop these things. You would do a breach of union law, or maybe the Commission starts an infringement. But it turns out that even though we do that, it takes long, very long, whereas at a national supervisor you would already have stopped it, and it doesn't solve the problem. If you let that happen, you actually create a door through which a lot more who want to do that can continue. So I think that is important, and that is how you need to think about it.
I'd like to come back before opening it up to the numbers that Jörg gave us. 13% of German insurers' premiums are cross-border, no more. Maybe a question to all three of you. Is that a bug or a feature? If we had a single market, would we basically have the same kind of ratio, or would it be higher? Maybe starting with you, Jörg.
I mean, that's purely guessing. So my sense would be it could be higher in non-life, because in life insurance you have a very strong link often to the tax system and to the social security system, with a link to labor market regulation. And since taxes, social security and labor market are purely in the competence of the member state, in life it's very difficult to imagine a extremely well-functioning common market. So in non-life that could be different.
I'm not the one who chose the visuals of our session with a form, which I know very well as a US taxpayer from the US individual Internal Revenue Service. Maybe this form has already been scrapped as we speak, I don't know. Indeed, taxation matters for many of those products.
An additional 25% if you are a EU citizen.
I'm not going to expand on that. Maybe, Andrea, on this question of single market and the potential for more market integration if the barriers that you mentioned were to be withdrawn.
So the question is?
If we had a real single market, would it stay at 13%?
Well, look, I agree with Jörg. It depends on how you take that into account. So, for example, clearly for Generali, more than, 2/3 comes from outside of Italy. But how do you consider Generali France? Is it cross-border? For us, it's really not, because it's a legal independent unit, business unit
That's
in
right.
France, right? And the same for Generali Germany, and the same for Allianz Italy. So depends how you treat them. If you treat them as not cross-border, I fully agree with Jörg. I think it doesn't change much. It would not change much.
So let me open it up to the floor. Don't hesitate to assert yourself, raise your hand, raise your voice, and I have a first question at the back of the room. I also have questions on Slido. And please introduce yourself and keep it brief.
Indeed. Thank you very much for the presentations. Lazaros Panurias, European Investment Fund. As European Investment Fund, you might know, we have achieved some modest progress also with investing venture capital investment of pension funds. My question, two questions if you allow me, Nicholas. One to Andrea. You mentioned the need more integration and more centralized supervision, or in fact centralized supervision. I thought the priority would be, when it comes to insurance companies, and even more for pension funds, the priorities will be capital requirements. Because if you see, even in a pure national context, is not maximize the potential of what the insurance companies, pension funds can invest in. That is one. And the second is because, as you said or alluded, we are running out of time. You are to identify an urgency because, you know, integration, centralized supervision can take, this is to any of the panelists who wish to take, integration, capital requirements, supervision, perhaps is only as far as it can go, and in any case will take time. So since we're running out of time, if you say insurance companies, pension funds to invest more, and of course from an EIF perspective and from a European perspective in venture capital, what that would be. Thank you.
And indeed, on Slido, we have a question from Daniela Stefanova, which very much echoes what you're raising. And I read her question: if you could point to 3 factors that would motivate insurance companies to increase their investments in venture capital and private equity, what would they be? So who wants to start with these issues?
I address his question first. So let me be clear. I said I would see favorably a central supervisor for securities markets, because I think that one of the reasons behind the fragmentations of capital market in Europe is the fact that we have 27 different regulators and supervisors. I'm not asking for that in the insurance industry. I simply said we would need more integration. Now, coming to your point, and I'm very brief, coming to your point on solvency. So if we look at our solvency requirement, at the end of the day, that is very much given by the market. So as you know, the minimum is 100%, but we're all above 200%. Why? Because if we go below certain thresholds, this has an impact on our cost of funding, on our ratings, and so on. So at the end of the day, it's the market setting our capital minimum requirement. But the way these solvency ratios are computed is in the hands of the national supervisor. So for example, they could say, well, your investment in China, we treat it this way, and it's different from the one it's treated in Germany or France. This is this is an obstacle to the level playing field, and that's where I see more action, more convergence, okay?
That's very clear. Jörg and Petra, do you want to expand on that and also on the venture capital piece?
I don't think a supervisor should advise on how to invest in venture capital.
I would not want the question about VC and private equity to leave it completely unanswered. So can I ask one of the... yeah.
So my view is, first of all, in private equity, we're investing more and more, okay? Because these are long-term investments, okay, which are consistent with the structure of our liabilities, and the risk profile combined with the other assets is, let's say, consistent with our risk appetite framework. Venture capital is a bit peculiar because it's much higher risk with the idea of the short-term, if you want, higher return. So I don't see that as so much consistent with our risk appetite, okay? I see it for other type of investors, if I may. Okay?
Can I...
Jörg first.
Yeah, so I think what we need to keep in mind is that there's 2 ways to get more capital to the... there's one way to get more capital, I think, to the market, or maybe 2 ways. One is indeed maybe we can more investment even more to EU that is now going abroad. Maybe we can get more retail investors involved by also saving for their retirement or for other. That is it. But keep in mind that it's always money that is actually meant to then in the end be paid back to that policyholder that needs a return. So I think that is, but it also needs it back. I think that is important. So that is one. It's not just about investment. It's about investment of money that is owned in the end by the policyholder. That's one. And I wanted to make another point, and I forgot.
Jörg.
Okay, then I give you a pause and then you can come back, Petra. I want to come back to my starting point. I mean, the question is always, and we have this also from national governments, you need to do more on venture capital, private equity, traditional equity, especially European equity, renewables, whatever. You need to collect this money from someone.
And national security now.
Yeah, not talking about defense, but you need to collect the money from retail savers. So the point is always, is someone willing to put his or her money that is there quite often for retirement into a specific product? You always need to link to the product, otherwise the investment part is disappearing. So I can say, or echo what Andrea said, companies based in Germany, we do significantly more on private equity in the last, if you look at 10, 15 years. There's also more activity on venture capital, but on venture capital there are limits for the reason that Andrea just outlined. You can mix it into your investment portfolio a bit to increase the return. And if we say a bit, the absolute amount can be still significant for the overall economy because we are the largest institutional investors. But it's not per se what we can do with the money that we need to pay out, in most cases, life insurance over a decade of 30, 40, 50 years. So traditional, or let's say, take infrastructure investment. This is much more suitable to the risk appetite that we have and the need that we have to pay this to policyholders. Yeah, it's boring. You get a certain fee each month if you have an electricity grid or you have an autobahn grid. This is perfectly suited for life insurance companies. Venture capital, you can mix it a bit, but the overall risk-return structure, I mean, you have 10 cases, 9 completely fails, and the one gives you 200% return. That might be nice for some investors, but for insurance company, that is not the traditional investment. You can mix it into your overall investment strategy, but there always will be limits.
So we only have a few minutes left, and I don't want to leave one question we have on Slido unanswered, which is about FIDA, which of course is the Financial Data Access Regulation, which builds on open banking and so on and so forth. So the question from Maria Ivoninaite is, what do the speakers think about the FIDA regulation's capacity to enable greater data sharing, diversify product offering, personalization, and competition? FIDA is coming. Petra.
I'll take that one. Yeah, so I think, and the problem with enabling legislation is that we are going to enable something, but it's not there yet. So it's difficult to actually see what it will bring concretely. And when we were asked to give input on this piece of legislation, we ended up creating our best idea of what it could look like. Created on paper an app and have no plans to build it, and then on the basis of that assess the risk and what you would then have to regulate. So currently for insurance, this is quite hypothetical. I mean, you can say, yeah, you can compare prices, you compare products, we can already do that. So let's...
But you can see, if you allow me, what happened with open banking, because that's in a way a similar piece of regulation.
No, that's it. That didn't really happen. PSD2 was... I was there when I was director of payments in the Dutch Central Bank. When that was implemented, it didn't really fly. So, but yet it's coming. And so what is then the benefit? There's a positive side. There is ways for consumers to have more control over data that they may not have today. They could get an overview that still needs to be built. So on the consumer protection side, conscious consent, ability to take that back, getting an overview of what you're in, yes. In data sharing, it's a bit one-sided. I think it is the financial sector sharing with others, but other sectors not yet sharing back. Mm-hmm. I think that is an imbalance because for some insurance products, it would be really helpful to also get some data. And then, and I really take this also from the PSD2 time that I worked with, what data are you going to share and how will that interact with the GDPR? And I truly hope that we're taking lessons on board today on how we do that. And so what is actually data you can share, what is intellectual property, what is sensitive data under GDPR. I think these are all questions that need to be really well assessed. Otherwise, you think you create something that at least protects consumers, but the reality is it is not. And it can create a lot of questions. And so an example on the PSD2 was that then when everything was arranged and with full conscious, I really want to share my data, there was consent. The problem was that then the one who was sharing actually also shared data from someone else because the payment was done by someone else or to someone else, which was a problem.
And of course, PSD is a payment service directive. Jörg, you have the final word.
Yeah, then I mean I can come back for an additional hour on FIDA if you wish, because it's a huge topic, and I share very much what Petra just said. I mean, if you look at the banking sector, was it really a success, PSD2? I would say no. There were huge expectations, but there were very limited use cases that we can see up to now. And my concern would be if you do it now in the insurance sector, that we are first forced to do significant investments for, let's say, data sharing schemes and whatsoever. And then the question still is, what are the use cases? Yeah, what could be done for consumers? What do they really want? So it's a question point if you are forced to upfront to invest and you don't see the use cases. There I have a question mark. So I would really start step by step. I would start with a limited scope that one can have here. And there's a question, of course, that data sharing goes in various directions. I mean, if you go and in the whole area of motor insurance, automotive producers are not really sharing data out of the car. So the question is, there is not a one-way street that it could be successful.
Actually, Andrea has the final word.
No, I just agree with my colleagues. I can't be in favor of mandatory data sharing.
So we already have a theme for the forthcoming Bruegel session. Thanks so much to Andrea Cironi, Jörg Asmussen, and Petra Hilkema for what was certainly for me, but I hope for the audience as well, a very thought-provoking session. I thought we covered a lot of ground. Special thanks to Andrea, because this whole idea of doing this session came from discussions with you, and not least to David Pincus, who, as I said, was the driving force at Bruegel for the organization of this. And have a great rest of your day. Thank you so much.